To fully grasp our discussion, it's essential to update some traditional market definitions and align them with our new vision. Adopting these updated definitions will provide clarity on our perspective and facilitate a deeper understanding of the concepts we are addressing. Time frame. When we refer to a time frame, we are specifically talking about a certain number of candles within that period. For example, when discussing a 15-minute time frame, depending on market conditions, we might consider 48 candles within this period. These candles are counted starting from what we call the reference candle and ending with the second time pivot in that time frame. Example: here we have the Bitcoin chart on a 15-minute time frame. This is the reference candle, which we will discuss later. It's important to note that the open and close prices of this candle are crucial. Typically, reference candles represent the high and low of a cycle within the time frame, but this isn't always the case, which makes identifying the correct candle more challenging. Every time frame has at least 2 and up to 4 time pivots. This is the first time pivot of the 15-minute time frame, and this is the second time pivot. You can see the entire cycle consists of 55 bars in the 15-minute time frame. Time pivot. A time pivot refers to the specific moment when the market is likely to initiate a significant movement. Entering the market at a time pivot in the correct direction, whether buying or selling, usually results in minimal drawdown. Each time frame has at least 2 time pivots, which are calculated through specific equations we developed. Whenever 2 or more time pivots from different time frames align, we identify a major time pivot. Let's look at the previous example in a higher time frame, such as 1 hour. This is the reference candle of the 1-hour time frame. Here, the first time pivot and the second time pivot of the 1 hour and 15-minute time frames align. You can see how the market changes direction at that time pivot and starts a new cycle. Time correction. Time correction refers to a sideways or range-bound market. It's important to recognize that during certain periods, the market accumulates within a range before starting the next wave of movement. While this isn't a new definition, we will discuss our unique perspective on time correction later. Price correction. A price correction is characterized by a rapid movement in the opposite direction of the prevailing trend in a higher time frame. This correction typically goes against the trend, but does not necessarily signal a reversal. Price and time correction. This type of correction occurs when both price and time cycles reach completion. Any given time frame can experience a combination of these corrections simultaneously. Cycle of a time frame. The cycle of a time frame refers to the period from the reference candle to the second time pivot. Once this cycle is complete, a new cycle begins. Reversal level or left behind levels. These are specific price levels, calculated using certain equations, that the price must revisit in the future. These levels are considered strong zones for potential price reversals. Time stop loss. As mentioned with time pivots, when entering the market at a time pivot within a specific time frame, a time-based stop loss can be set. If the position is not profitable after a certain period, it suggests that the position is not in the correct direction, and an exit should be considered. By understanding and adopting these refined definitions, you can better comprehend the dynamics and strategies involved in our market analysis. We're excited to announce that we'll soon be introducing our free services. Follow us to stay updated and be the first to know about new offerings.